And Derek Burleton, Deputy Chief Economist at TD Bank, for some greater insight and how we take today's statement and apply it to what might happen in July. Derek, thanks so much for being with us. I don't think we're getting any real surprises here, but it does kind of set the stage for, the July report, where they're going to have a lot more information in terms of what that recovery looks like.
Yeah, absolutely. No forecast today, no new forecast. Very little in the statement in terms of, specific numbers. But so I hadn't expected much today. The bank's in autopilot right now, at least for the time being. I do agree that come July, and maybe even beyond that, I think to me an important shoe to drop will be when the Fed pivots. And I wouldn't be surprised the Fed will begin its pivot as early as the Jackson Hole Symposium in August. So once that happens, I think the Bank of Canada will have a bit more flexibility to, push some of this mantra that, it's starting to shift to the other side. More what I view as a risk management framework, where it's not just about getting the economy back to recovery, but managing some of the risks associated with inflation and also housing activity and something that's more in the middle. So I think the Fed, that'll be very interesting to see how that story unfolds in the coming months.
Well, you mentioned flexibility. One thing that the Bank of Canada highlights as a potential risk, even though they acknowledge the progress that we're making on vaccines, is the uncertainty about the evolution of new COVID-19 variants. I think we're all very excited to put this whole pandemic behind us, but the variants do loom. From your perspective, does the Bank of Canada have the wiggle room to potentially backtrack, not taper as much as it's signaling that it will? Does it have room to kind of go backwards as much as it does to go forward?
Yeah, it does have the room. I think, the rationale would be clear. If we do get hit by a fourth wave heading into the fall, the mutations get worse. Clearly the Bank of Canada is ahead of most of the major central banks in terms of signaling that they're going to kind of shift to taking out some of this extraordinary stimulus. So I certainly see some wiggle room. I don't anticipate, of course, forecasters generally aren't anticipating a major fourth wave that would knock a lot of these forecasts off track in any large extent. But certainly it's a risk. It's something that we kind of throw a caveat in almost every forecast. That's the downside. I think the upside risks are also very important, and this is where the bank could end up moving even before. We've got a rate hike in the fourth quarter of 2022, so a little bit ahead of other forecasters, but it could even be sooner if we get a major explosion in growth, consumer spending, a lot of excess savings kicking in. A lot of this isn't embedded in baseline forecasts. So I think the risk profile is fairly evenly balanced, which is consistent with some of the Bank of Canada messaging.
Derek, when it comes to the course that the Bank of Canada is on, it's similar to what the Fed is saying as well. Don't worry about these inflation prints that you're getting. We're going to get one from the Fed tomorrow, and from the estimate from the street, it's going to be pretty hot from the U.S. economy CPI, and the Fed probably speakers will come out and say, don't worry about it. We're singing the same tune. People look at what happened in the housing market and the equity market, asset inflation because of cheap money. The Bank of Canada is addressing it, but not addressing it in the sense that they're not willing to move off their monetary policy stance to correct anything that's happening in the housing market. Is there a point where their hand gets forced, or is this simply Tiff Macklem keeps telling us, listen, I got bigger problems to worry about than the housing market, that's just going to have to resolve itself?
Yeah, I think they're kind of leaving that to some extent to regulators. The banking regulator just tightens some of the stress testing. They'll wait and monitor to see how that might play out, past some of the rate increases we've seen, albeit pretty modest thus far, but still affecting the affordability equation. Yeah, I agree. I think in the near term, they're going to rely on this temporary story. And I think most forecasts, the problem is we don't have a lot of past experience in which to base this on. This is very unusual, getting this kind of V-shaped rebound in demand in Canada, the United States, and globally at a time where supply is just trying to catch up. And the 70s is not a very good comparison, albeit some parallels, but it's just such a unique circumstance, the pandemic. So there is time. I think most of us are kind of stretching out this period of transition where supply will catch up and address some of these imbalances, and demand will cool for some of the goods as some of the spending shifts to services. They've got maybe 5-6 months. I think a couple of things are going to continue to really focus, other than just housing activity. Wage inflation. They'll be monitoring that in the coming months, and inflation expectations. How well anchored are they? And thus far, they remain, even though they've crept up, they remain pretty well anchored. If those really begin to change, then that could pull forward some of this communication.
We don't hear a lot of concern about the rising Canadian dollar. Perhaps at any other point in history when we get to these levels or we see this kind of rapid rise, this would be something you would hear manufacturers, economists, perhaps even the Bank of Canada touch upon. Not mentioned in the statement. Tiff Macklin made some comments about it in May, but it's not talked about a lot. Why is that?
Well, I think they've been pinning some of it that's fundamentally driven on rising commodity prices. As long as you get that offset on incomes, it's not something that's going to keep them up at night. He has mentioned that they're monitoring it, and I would imagine if it went up from the current levels, they would increasingly jawbone it. We may hear something tomorrow. I wouldn't be surprised in the upcoming speech from the deputy governor. We hear from tomorrow that he may broach some of it, so we'll keep our eyes out for that. But, I think it's just the offset. While we focus a lot on real GDP, real economic activity, Canada's seeing a really big rebound in nominal activity this year that's tied in part to nominal commodity prices, rather, in some of the rallies. So, that's clearly embedded in their forecast, and it leans them a bit optimistic, clearly, and that's justifiable, I think.
Just to close the loop on what you were saying about the Fed and how Jackson Hole August could be a turning point here. Inflation, the Fed decision on both sides of the border are really important, kind of something that the market is watching, and yet we're seeing a bond market rally that seems to, at least, over the past couple of months, be shrugging off the concerns of inflation. What's your view on what the market is pricing in, and are they starting to buy into the central bank view, a lot more about this transitory nature of inflation?
Yeah, I think they're cutting them some slack. I think part of it is just demand driven. Despite big deficits and the like, just demand for those securities runs large right now. So some of this is technically driven. The inflation expectations, the market measures, the tips, big demand for that right now that may be holding back some of the measured implied inflation expectations. So I think some of these survey-based measures will be important. But yeah, it's going to be an interesting story. I think the bond market is, giving them credit where credit's due, and they're keeping their eyes on many of the same measures. So it can turn quickly, and it only takes a little bit of a pivot, and all of a sudden we'll probably see the 10-year longer end of the bond curve start to respond. But I have been surprised at how yields have come back a bit, even with some of the demand push. And I do see it being a short-term in nature. We have the 10-year, both Canada and the U.S. government securities hitting 2% by the end of the year. We were moving towards that, and then they pulled back. But I think it wouldn't take a lot. Another inflation, maybe even later this week after tomorrow's inflation report, we could see some of that begin to happen.
All right, Derek, thanks so much. You've given us a lot of instant analysis. We appreciate that. That's Derek Burleton, Deputy Chief Economist at TD Bank.